Well, welcome to Q2. In this video, we'll take a look at how financial markets have performed during the first 3 months of 2026 and what that means for people who are investing for the long term. After a solid year in 2025, markets ran into some headwinds as 2026 got underway. A conflict in the Middle East, rising oil prices, and fresh questions about the economy all made investors more cautious. At the same time, many areas of the market stayed resilient, and the core principles of patient, long-term investing remained as relevant as ever. Over the next few minutes, we'll walk through the main factors that shaped the market performance this quarter and share some thoughts on what the road ahead may look like. Let's start by putting the recent market dip into context. The S&P 500 is a broad measure of large U.S. company stocks. It dropped by 4.3% in the first quarter, including dividends. So, for some people, that kind of a drop can feel alarming, particularly after strong returns that we saw in 2025. But here's an important piece of perspective. Market pullbacks like this one are completely normal. Going back to 1980, the S&P 500 has on average fallen around 15% at some point during any given year, even years when the market ended up finishing higher. In fact, markets have delivered positive returns more than 2 out of every 3 calendar years, even while experiencing multiple ups and downs along the way. Interestingly, the first quarter of last year also saw a 4.3 decline for the S&P 500, driven by concerns about the tariffs at the time. And yet, markets went on to finish 2025 with a total 18% return. Of course, past returns do not always guarantee future outcomes, so this is not a forecast for 2026, but it is a helpful reminder that short-term market swings and long-term investment results are two very different things. Now, let's look at the biggest story of the quarter, the situation in the Middle East and its impact on oil prices. Disruptions to the Strait of Hormuz, a critical waterway that carries roughly 20% of the world's oil supply, led to production costs across the region. As a result, the price of Brent crude oil ended the quarter at about $118 per barrel, which is up about 94% for the year so far. Higher oil prices hit consumers in 2 main ways: directly at the gas pump and indirectly through higher prices on a wide range of goods and services. The national average price for gasoline reached $4 per gallon by the end of March. That said, many economists view that this type of a price spike, one caused by a supply disruption rather than underlying economic conditions, as temporary. We saw a similar pattern in 2022 when gas prices climbed to $5 before falling back down within months once conditions stabilized. Historically, geopolitical events tend to create short-term uncertainty, but have rarely knocked long-term market performance off course. Investors who made big changes to their portfolios in response to these past crises often did so at precisely the wrong time. Now, turning to the job market, the economy has slowed somewhat from the pace of recent years, but the overall picture remains reasonably healthy. In February, the economy shed about 92,000 jobs, and the unemployment rate, which is the share of people actively looking for work who cannot find it, ticked up to 4.4%. For the first time in several years, the number of people looking for work now exceeds the number of available job openings. As recently as 2022, there were 2 open positions for every 1 unemployed person. So this represents a notable change. The context here is important, though. Both the number of workers available and the number of jobs being created are slowing at the same time, which is partly a result of lower immigration levels and an aging population. The unemployment rate still sits near historically strong levels, and consumer spending, which accounts for more than 2/3 of the total economic activity, has continued to hold up better than any of the analysts had expected. Let's look at how different parts of the market have fared, because the overall index numbers do not capture the full picture. Even though major market indices are in negative territory for the year, 6 out of the 11 major sectors within the S&P 500 have actually posted positive returns. The energy sector has been the standout performer, gaining nearly 40% through the end of March. More defensive areas of the market, which means sectors that tend to be more stable during uncertain times, such as consumer staples, utilities, and industrials, have all held their ground. On the other hand, information technology has dropped about 9%, and many of the largest technology companies have really lagged behind. As this chart shows, the sectors that lead the market tend to shift over time. Energy was also the top performing sector in 2021 and 2022 before technology stocks really took over for the 3 years following. The key reason why holding a well-diversified portfolio, one that spreads investments across many different sectors, matters so much. Picking which sector will come out on top in any given year is extremely difficult, and a balanced approach helps investors navigate a variety of market conditions. Finally, let's touch on trade policy, which took a surprising turn during the quarter. At the end of January, the Supreme Court ruled 6-3 that certain broad tariffs were unlawful. The administration responded by turning to a different legal authority to pursue its trade agenda, and has also launched new trade investigations in recent months. For investors, the main takeaway here is that the general direction of trade policy is likely to continue, and the markets have shown to be able to adjust over time. There will likely be additional sources of uncertainty as the year progresses, including a leadership change at the Federal Reserve and upcoming midterm elections. The lesson of this quarter and the past several years offer clear guiding principles. Stay invested, keep long-term goals in focus, and remain steady through whatever challenges may come. I really hope you found these insights helpful, and if you would like to learn more about any of these topics, please don't hesitate to reach out. I'd love to hear from you.